We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Alasdair Macleod, Head of Research at GoldMoney. How are you today, Alasdair?
I'm well, thanks, Tom. Thanks for having me on.
Excellent to have you back and to chat as always. So I'd like to start by getting some perspective on the markets from you. Why does it seem that there is a move into U.S. Treasuries and a flight out of risk assets on the fear liquidity tightening is being overdone?
Well, it's all a bit sort of odd, really, because we've got record levels of reverse repos going through. I mean, I think that's very nearly $1 trillion. And what's happened in this is that you've got a combination of the Fed doing 120 billion a month of QE and the US government spending down, in other words, putting into circulation money which otherwise is not in circulation from its general account at the Fed. So, and that's a further trillion, really, from about last October. So, 2 trillion of extra money going into the market, roughly in the last 6-7 months, maybe 8 months. And the banks just don't have the balance sheet capacity to take all this extra liquidity. And so the Fed was finding that if it didn't do something about it, then what with banks turning away large deposits, what would have happened is that the banks would have said, okay, we'll take that deposit on, but you're going to have to pay us interest in order to do so. And so that would be negative interest rates. Now, the problem with this is that the people with all the money, of course, are the money market funds. And money market funds are held by people who want liquidity on the basis that it's safe. And, you go in at $1, you get whatever interest is, and whether it accumulates or is paid, immaterial. But the thing is, you're going to get $1 back. Now, if you get negative interest rates, you're not going to get $1 back. So it's, that's what I mean by breaking the buck. I mean, it was a phrase which was used by this industry in the past. And I think I last saw it used at the time of the Lehman crisis when there were all sorts of worries surfacing. That I think was the underlying situation. But then we've had it all got slightly odd because we saw that bond yields started collapsing. I mean, that if you looked at the 10-year US Treasury, it fell from about 1.75 down to below 1.3. That's quite a significant move. I mean, certainly in percentage terms on a very low interest rate or very low yield. Meanwhile, at the same time, the US dollars trade-weighted index was rising. Now, normally, I mean, from the perspective of the precious metals market, you would think that hedge funds are watching that trade-weighted index. So when the trade-weighted index goes up, it's, buy dollar, sell gold, because they think like that. That's the way they trade. And also, when you look at bond yields, the conventional way in which fiat money men look at it is that a higher bond yield is a penalty against holding gold because they assume that gold doesn't yield anything. Gold always yields less than fiat currency. Yeah, that's fine. We can understand that. But they still think in terms of penalty. In other words, they just don't understand that actually the point about gold is that you're getting out of fiat completely. It's not an interest rate story at all. But that is what drives the market. If the market thinks it's an interest rate story, then we can't ignore it. And so we had this sort of, if you like, sort of contradiction. On the one hand, you had the dollar showing strength, and this is admittedly mainly against the euro, which normally would push the gold price down. And at the same time, you had falling bond yields, which would drive the price of gold up. Now, whether it matters or not, I honestly don't know. But what we have seen is that the price of gold has held around about $1,800. And every time it's dipped below there, buyers have come in and bought it. And every time it's gone above, someone's put a cap on it and driven it back down. And it's been like that for 2 weeks now.
So how do the new Basel III net stable funding ratio requirements discourage banks from taking short-term deposits?
The point about the Basel III regulations all centers on one thing, and that is that what Basel III tries to achieve is to take the risk out of the banking system arising from a mismatch between the sources of funding, in other words, the liability side of a bank's balance sheet, and the assets which those liabilities are funding. So what they have done is they've introduced something which is called the net stable funding ratio. Now, the net stable funding ratio takes the available stable funding, which basically is on the liability side of the bank's balance sheet, and it classifies those by various means in terms of stability. Now, something that is not stable at all, as far as Basel III is concerned, as far as that ratio is concerned, is excluded from funding anything on the asset side. On the asset side, you have the required available funding, and then ratios are put on that as well. So if we look at something like gold, for example, the required stable funding is 85% of the value of that gold position. But on the other side of the balance sheet, anything that is held against that gold, customer deposits, let's say, which are unallocated gold positions, are not available at all to fund any of the gold positions on the asset side. So you can see that suddenly this is a very inefficient use of the bank's overall balance sheet. Now, it doesn't stop a bank running positions, but what it does is it discourages them from doing so. And this has been the case, I think, in virtually all the interpretations of Basel III into local regulations, with the exception of the UK, who only on Friday released their draft Basel III regulations, as it were, which are going to be implemented at the end of this year. In America, it's already implemented from the beginning of this month. In the EU, it was implemented from the end of last month, so more or less the same time. So the UK hasn't done it yet, but the reason that they have introduced what they call a near final draft, in other words, there's going to be very little change between this and the final. The reason they've done it now is to give banks time to work out what they need to do in terms of treasury operations, to work out which lines of business they want to exit, which lines of business they might want to switch towards. So it's a 6-month, if you like, sort out as far as banks operating in the UK are concerned in order to come in line with the rules. There is one extra article which has been inserted in the UK draft regulations compared with the European ones upon which it is based, and that is it's from memory. I think it's Article 428F. Yeah, that's the. Trying to remember the numbers of these things. Now, the first paragraph is interesting because what it does is it permits the LBMA settlement system. It's a sort of central clearing system, if you like, which is called Aurum, and it's run underneath a company called the London Precious Metals Clearing Limited, and that is owned by 4 major banks. You've got JP Morgan, HSBC, Standard Chartered, can't quite remember, and UBS. So you've got those 4 banks who are operating it. Now, you can see that the way I've described this net stable funding ratio, that these banks would be reluctant to continue to do this. What has happened is that this extra Article 428F has been introduced in order to permit this to happen. And it's actually very, very prescriptive on this. And the full rule on paragraph 1 is an institution may apply to the competent authority. In other words, the members, anyone who is part of the LPMCL has got to have the permission from the Bank of England to be part of it. Competent authority for permission to treat an asset and a liability as interdependent. For the purposes of the article, an asset and liability are independent where either conditions A to F below are met or where paragraph 2 applies. Now, where this interdependence basically means that one side of the balance sheet has got to be exactly matching the other side of the balance sheet, and they must relate to each other. So you can't have, say, the sort of coverage that you get. We've got an option on this side, which covers our liabilities on this side. No, you can't do that. This has got to be absolutely straightforward. And the reason this matters is that when you've got a central clearing authority like Aurum working under the LBMA, then effectively it's just matching, the buyers and sellers at maturity, and they all cancel each other out. So that is the purpose, if you like, of this rule. So what it means is that the LBMA can continue. But then there is a second paragraph to this rule and a third one. And I think the third one probably says it best. And the interdependent asset and liability treatment shall only be available to the extent that the institution's unencumbered physical stock of each precious metal is matched by customer deposits in a precious metal, and shall not be, any excess physical stock or customer deposits in a precious metal shall not be treated as an interdependent asset or liability for the purpose of paragraph 1. An institution's precious metal accounts or any other institution shall not be considered a part of the institution's physical stock of precious metals. What they're saying with this is that you can offer your customers an unallocated deposit, if you're a pooled deposit arrangement, so long as it is completely backed by physical bullion. So, in effect, what the bank is saying is to the LBMA, okay, you can continue in business and you can continue to run the world's gold market out of London, but no derivatives. No derivatives. This is interesting because the next question that obviously arises is what happens to a market which is almost completely derivatives? I mean, there are physical settlements within Aurum would take place, but they are a small minority of the total. And I think the answer is that quite a lot of participants in the market will probably decide to leave because they can't. The derivative game is effectively over, so they're not going to be interested in continuing. But the ones that will continue will say, okay, well, we can continue to offer a service which our clients want or our customers want, but we're going to have to run physical positions. So they're going to have to go in and buy physical gold, physical silver, platinum group metals to cover their customer accounts. Now, if you look at the Bank of International Settlement figures on derivatives, the last known position that we had for forwards and swaps, which basically is the London market, is around about $530 billion worth. Now, that works out on the day in which this was measured, which was the last day of December. This works out at around about 7,350 tons. So obviously, I would have thought that quite a lot of people punting in the market would not be interested in continuing to do so because, they're derivatives traders, whatever, they've used it for whatever purpose. If that facility is going, they will go from the market. But quite a lot of people have been holding on to unallocated gold accounts on the basis that it gives them protection against the debasement of their accounting fiat currency. So they are likely to continue to want to have a gold or silver or platinum group service. So somewhere between 0 and 775,000 tons is likely to be the extra demand that will result of the LBMA moving from derivative unallocated into physical fully allocated.
So, Alasdair, just to kind of summarize this, is this basically going to remove a lot of, obviously, the derivatives contracts, but also a lot of the liquidity and cause more volatility in the price of the metals?
I think it's inevitable, yes, because it's not just the users of the market that we would think of, probably people like ourselves, people a lot richer than us, sort of large funds taking positions and so on and so forth. It's also central banks and that sort of wealth funds. They're all dealing in this market, and that facility is going to be taken away from them in effect. And of course, these are the same players to a large extent who also operate on COMEX. And the relationship between the two markets always used to be that, if you had a position in London, you would hedge it on COMEX. So you were short COMEX. And indeed, a short position on COMEX is in the order of $30 billion or around about that. That's the net short position at the moment. So there is going to be some sorting out to do, and there is no doubt that by removing the flexibility of a large market and to just sort of effectively kill it, fairly quickly, not overnight necessarily, but fairly quickly, is going to introduce some serious liquidity problems for the market. So volatility is bound to increase as a result of this.
Mm-hmm. Something that I'd like to touch on as well with you, Alasdair, is you and I spoke about, or before the call here, before we hit record, about the enforcement of these rules. So how will that work? And is that something you foresee as being an issue?
I don't really see it being an issue in that sense. There are issues involved, yes. But this is basically enforced by banks being made to make regular returns to the regulator, and the regulator will look at the net stable funding ratio. It will get, if you like, it will put a bank on notice if it finds that it's very close to one and threatening to go under in its opinion, because it must be, that's the point about the net stable funding ratio, it must always be one or greater. So it's a question of the regulators watching how these guys operate. Now, it's perfectly reasonable to assume that a bank which has got room on its balance sheet within that net stable funding ratio calculation to take derivative positions on the basis that they're unfunded from the other side will do so. There's nothing to prevent him from doing that. But in his overall balance sheet, he's got to ensure that he always maintains the net stable funding ratio at one or more. And if he doesn't do that, the regulator will jump down on him. So
is this possibly the end for gold and silver manipulation, to put it very explicitly?
Well, I'd like to think so. But I would say that, of course, it depends how you define manipulation. If you've got a large player in the market, that's the market, isn't it? But I think it's a very good question from one point of view, and that is, I think it's going to be less easy for governments to interfere with the market covertly, as it were. They obviously can interfere overtly, like turning around and saying, we're going to ban you from holding gold or whatever. But the idea that, say, an exchange stabilization fund can go in and just sell 10,000 gold contracts on COMEX. I think that's getting less and less likely, because the exit, if you like, from such a trade is getting more and more difficult. So I think generally, when you take away these derivatives, and it's going to be also futures as well as forwards. Basically, these markets are going to narrow down quite a lot. I'd hesitate to say they'll disappear completely, but they're going to narrow down quite a lot. I think that will reduce the amount of interference, simply because You can't get out of a position which you take in order to drive the market one way or the other. So I don't see the end of manipulation. These markets are, particularly gold is such a, it's such a political potato. I think it's very difficult for governments to avoid intervening, if you like, in the market when they see fit. But it's going to be more difficult for them to do so. So in that sense, I think these regulations are a good thing.
So as you were mentioning the big short position on the COMEX, I was speaking with Dave Kranzler yesterday, and he said that at times he doesn't trust the commitment of traders' reports. So is it possible that this isn't always an accurate way to evaluate the positioning of some of the bullion banks?
I think that's absolutely right. Really from 2 points of view. If you believe in statistics, you may as well believe in fairies. So in that sense, I'm sure everybody fills out the forms correctly and it's all tickety-boo. But forgive me for being a little cynical. I think the other point I would make is that the derivatives trading on COMEX gold contract is probably around about somewhere between 1/8 and 1/10 of the total around the world, because the forward market in London is far, far larger. It really is. It's a far larger market. And of course, being over the counter, we don't see what on earth is going on. The LBME have been dragged kicking and screaming into providing some statistics. And always they're a little too late and they're not quite relevant and so on. You've got to really look elsewhere. My calculation of the outstanding value in terms of metal of the London forward contracts, I had to go to the Bank of International Settlements for it. They're not going to provide it to us in London. They'll give us daily settlement figures, but that's completely irrelevant. It really is. And also the other thing I should mention is that the figures that are given by the LBMA, after a certain amount of time, are only settlement figures between LBMA members. It doesn't tell us what the transactions are between LBMA members and the general public, or if you like, non-LBMA members. And they tried to do this once. I think it was back in about 2011. And what we have found, looking at those figures relative to the figures today, is that the amount of trading between LBMA members and non-members is in the order of 5 times the trade with LBMA between inter-member trades. So they're not even giving us, they're just giving us the tip of the iceberg, actually. So we have to go elsewhere for the numbers, which seems crazy, but that's the way it is.
Mm-hmm. Alasdair, as you were mentioning that gold seems to be such a political hot potato, what inferences can we make about the behavior of China and Russian central banks continuing to buy so much gold? Is it possible that they're preparing to have it revalued higher and have it partially back some of their currencies in some way?
There are good reasons they're buying gold, yes. And it's, if you like, an escape from the dollar, which I think is probably the most important point. But the Chinese situation is interesting because you have to go back to when the People's Bank of China, the state bank, the state central bank, was first appointed the monopoly of gold and silver dealing. And that was way back in 1983. So we're talking about something which is, 38 years ago now. Now, what happened was that no resident in China was allowed to hold gold at all, or silver for that matter. So during the time between then and when they were permitted, which was 2002, which was when the Shanghai Gold Exchange was founded, it's quite clear that the state accumulated a pile of gold. In particular, we'll talk about gold rather than silver. It did this, right, for obvious reasons. Others have done this in the past. I go back to the Arabs in the 1970s, when Nixon took the dollar off the gold standard completely. Effectively, he and Kissinger said to the Arabs, look, we can't stop you charging what you like for your oil, but the one thing we're going to insist on is that it's priced in dollars, and that you run your surpluses in dollars through our banking system. And of course, that money was then lent for political reasons to Latin America, and all disappeared, basically. Then you had the Brady bonds to try and rescue the whole thing and all the rest of it. Another example was Germany after the Second World War. When Germany's economy began to recover and really build and got going nicely, it started, buying gold. It put dollars into gold, sort of substantially held at the New York Fed. The Arabs were doing the same thing. I didn't quite finish that story. But, for an Arab, they were looking at, as far as they were concerned, and we're talking about Bedouin stock, basically, what is property? It's not money as far as they're concerned. It's gold, and it's nice flash houses and a really good camel, So, gold is so much in their psyche. So they were putting a figure like 10, maybe 15% of what they were earning from oil revenues into gold. And China had exactly the same view. It did not want to have just dollars because it knew that dollars could go to nothing and they would have no control over it. So what do? You have some insurance against it. And so between 1983 and 2002, the People's Bank of China accumulated huge quantities of gold. Now, I know this basically from the way the regulations appointing them were written. We also know this because China invested an awful lot of money into gold mines and became the largest producer in the world in short order. We know this because the state still controls and runs completely all the gold refining industry in China, and furthermore imports doré from other countries. We also know this, that no gold leaves China at all. So, is this do they like gold? Like hell they do. They really love it. It's quite clear. So, and also anecdotal evidence, through contacts, they tell me that this has been distributed around various accounts. For example, the PLA, the People's Liberation Army, has stacks of it in warehouses. The Communist Party account has stacks of it and all the rest of it. None of this is appearing really in the official reserves. So they've got loads of it. And the answer, I think, is they're not going to use it to back their own currency because that would limit what they do with their own currency. But it is an insurance policy against a collapsing dollar. And you must remember that Marxist universities, where all these guys learned their economics, the number one thing that they say, which is something that Marx said, and that is that capitalism destroys itself and their currencies with it. So, what are the Chinese doing? They're insulating themselves against the collapse of capitalism.
That's a very interesting point, Alasdair. And I think, right in that vein, we're talking right now about the US is printing $120 billion per month, right? And interest rates at all or near all-time lows. So of course, everybody sees inflation coming. You and I have spoken before about this, but I'd like to get your take on seeing how things are developing since the last time we spoke in March and the type of inflation you see going forward. As you say, this currency is basically destroying itself. So I want to get your take on how you see this inflation developing.
Yeah, I think anyone who listened to our previous discussion back in March, I don't think would be terribly surprised or shouldn't be terribly surprised to see that prices are now shooting up everywhere. When you get all commodity prices basically rising, it's not just the commodity prices, it's the purchasing power of the currency. And that was quite clear from March last year when the whole of the commodity complex turned around. Suddenly prices shot up. Oil is now what, $74, $75 WTI? Copper is sort of up on the air substantially. There are a few things which are sort of a bit choppy in there, like lumber in particular, which catches the headlines. But basically, the origin of price inflation is monetary inflation. And there's been an awful lot of monetary inflation. The 120 billion a month that you referred to is specifically going into the hands of investing institutions. And those are particularly pension funds and insurance funds. And in return for the 120 billion going in, they then sell to the Fed or transfer to the Fed US Treasuries and agency funds. And that's the 120 billion. They invest that 120 billion in higher risk assets, which are corporate debt, for example, and also equities. So you have this situation where the investment going into corporate debt suppresses debt yields for corporates, which makes them look a lot better than they really are. And it also puffs up share prices in the equity market, making things look a lot better than they really are there as well. Now, the last time that someone really did this was John Law back in France in 1720. And we know what happened there. I mean, basically what he did was he printed French livre because he, amongst other things, he was the controller of the currency. So he printed livre to go and buy shares in his venture. And when there were calls, because these shares were always issued on a partly paid basis, which made lots and lots of money for the early investors. But there came a point where suddenly calls were due, and they were selling shares in order to meet the calls. So what was John Law doing? He was printing money to buy the shares. And basically, once you get into that sort of situation, when your share bubble starts popping, then at that stage, it takes the currency down with it. And that's exactly what happened in France. So let's fast forward 300 years and look at the current situation. They are printing dollars, they are printing euros, they are printing pounds, they're printing yen to keep stock markets high and to keep them bubbling. And at some stage, this is going to go wrong. Now, this is where we start talking about the effect of inflation, because the effect of inflation, monetary inflation, is to drive up prices, which drives down the purchasing power of these currencies. So they're already weakening. And as soon as you recognize that point, you begin to recognize that the only thing that can happen from here is that interest rates reflecting the time preference on these fiat currencies have got to go up. What's that going to do to the stock market bubble? I mean, you don't need to, this is not a difficult one to see. It's going to pop the bubble. And I would reckon that the way prices are going through, the way they're increasing, the way the Fed and other central banks are sitting there saying, this is transitory, this is transitory. They know damn well it's not transitory. They're just whistling, hoping that something will turn up. It won't. They will have to put up interest rates, probably at the end of the summer. And when they do that, the bubble pops. What do they do then? Do they taper to try and make things look better? No, like hell they do. What they do is they increase the rate of quantitative easing, because what they want to do is to keep the bubble going. So they're going to have to up it from 120 billion to, 200 billion a month. 250 billion a month, whatever. So they're destroying the currency to keep the bubble going. But what alternative have they got? Do they just stand back and let it all fall down? They don't have a mandate to do that. And that's the important point. So we are stuck in this situation where there is only one outcome, and that outcome is rapidly approaching.
So to illustrate this point, Alasdair, you in another one of your articles, you wrote that there's a sentiment indicator on equities here, and it's absolutely astounding to me exactly how dramatic it really is. So tell us a bit more about what this indicator is and how clearly it's shouting the extreme greed and total absence of fear of losses right now.
I think you must be referring to the FINRA statistics on investor borrowing to buy equities, and that is actually real bubble stuff. I mean, back at the time, and this is from memory, so please don't pick me up on details, but back at the time of the Lehman crisis, I think that stood around about $200 billion was borrowed, if you like, by investors in order to gear up their positions in the market. That is now, I mean, I haven't seen the June figures and May figures, but the most recent figures we have got, we're looking at a figure of over $800 billion. I mean, 4 times what it was at the time of the Lehman crisis. This is mad, absolutely mad. So you can see that the extent of the bubble is the highest it's ever been by a long, long chalk. And it's an interesting situation. I mean, I've been through a number of bubbles, and you had the psychology of it is that an investment manager cannot afford to not take part. He cannot afford to sit on the sidelines and watch prices go up, because if he does that, he's out of a job. If he is fully invested and it collapses, then he's just got to hope that his losses aren't as great as his competition's losses, and he will turn around and say to his poor, long-suffering clients, haven't I done well? I've only lost 90% of your money and the index is down 95,
What a positive.
So we're in that situation where, the extent of this bubble, I would say, is at least where it was in 1929, October 1929, or rather September 1929, before the collapse, which is interesting because if you go back to January last year, when the market first peaked, it then collapsed. The S&P lost a third of its value. We forget this, but it lost about a third of its value between it's really over a very short period of time between, I think it was sort of beginning of February into the middle of March. And at that point, the Fed turned around and said, right, interest rate 0, and we're going to do 120 billion QE a month. And at that point, everything took off. Which, as I say, was actually more an indication of the destruction of the dollar than anything else. But equities have been in a bull phase since then, and they have rarely risen. I think they've almost doubled on the S&P. I mean, it's not far off that. And of course, everyone can see this. Everyone thinks, well, the Fed's in there buying, or forcing the institutions to buy 120 billion a month of corporate bonds and and equities. We better buy as well. And furthermore, because we probably missed it at the beginning, we better gear up so that we get back on track. I mean, this is madness. It is complete madness, and it will end up destroying the dollar.
So, Alasdair, can you give us some comparisons or some different perspective on if there's a similar situation in Europe or in the Bank of England, for example? Like, is there stock market bubbles like that other places than just the US?
Stock market bubbles are everywhere on the basis that central banks are printing money, in effect, to keep them sustained, and printing money to keep bond yields down, to cheapen government borrowing. The amount of QE that's gone on in the UK is proportionately about the same as in the US. Our market hasn't behaved quite so well because sterling has risen against the dollar since last March. It's risen quite well, but we've had some special factors like Brexit and so on and so forth. The Eurozone has also been printing money, but doing it in a slightly different way. It's less going into equities, as it were. It's more financing government deficits in particularly the Latin countries, the Italians, the Greeks, the Spanish, and so on. And so it's been much more of a bond bubble, if you like, and equities have been valued on the back of that. Japan, of course, has been in there. I mean, just buying ETFs. I mean, central bank investing directly into the stock market, not messing around with QE. We just go and buy the ETFs, and that's what they've been doing. So that's been a major factor there. China less so. China has actually been very responsible in this, at a government level anyway. And because they also control their banks, they have been very careful for this not to generate into the same sort of bubble. And actually, it's quite interesting seeing the difference between China and the rest of us. It's almost as if China is saying, I don't think we want to be part of that party. That is something that we want to stay clear of. And I think they've been very wise about it, actually. The Chinese, I mean, it's a completely different system, and there's an awful lot wrong with the Chinese system. But in terms of monetary policy, there's a lot less wrong with China than there is with the rest of us.
I was reading an interesting article last night from John Authors, and he was pointing out that their CPI index is nearly flat, but their PPI index has risen exponentially. And so he was making the point that they're basically exporting their inflation.
Yeah, I don't think I'd quite go that far. I think I would take a slightly different interpretation on it. And that is that if you've got the PPI rising like that and not the CPI, either the numbers are wrong or the CPI is about to rise very, very substantially. And I don't trust the figures at all. I mean, the idea that consumer price inflation is in 2.3% or whatever the figure might be at the moment, I think it's a load of nonsense. And that I think is demonstrated very, very clearly by people like John Williams at Shadow Stats, who have continued the CPI calculation on the 1980 basis. And as far as he is concerned, I think it's sort of over 11%, nudging 12%. It's a huge difference. It just shows how unreliable these government statistics are, which everybody hangs on. I mean, it's complete nonsense that you should pay any credence to a government department producing self-serving statistics. I mean, it's unreal. But that's, sooner or later, I think the whole of that sort of story is just going to collapse around government ears. And, if it didn't affect us, I would say serve the buggers right, if you pardon my French.
So, Alasdair, is there any difference in the US dollar, because it's the reserve currency of the world? Is there any difference where they're printing like crazy, or let's say, proportionately the same as, for example, the Bank of England? Does that affect them less, or does that create a more volatile situation when the rest of the world says, I don't want dollars anymore?
The problem with dollar printing is that the dollar is everyone's reserve currency. I mean, okay, we sort of semi-excluded Russia and China, but I mean, even Russia gets paid for her oil in dollars. So, it is the international currency. It's the one we all use. It's the one that backs us because we're not using gold anymore. So if the dollar goes down the pan, we all do, and that's almost irrespective of what local monetary policy is. I think the importance is that the dollar is talisman for the whole fiat currency system. That goes, all fiat currencies go. Now, there is an exit route from this, and that is at some stage, whether it's government treasury departments or their central banks, need to back their currencies with gold. And they will do that very late in the game. They're not going to do this early in the game at all. So I can see a situation where you get a rapid collapse in the purchasing power of the dollar, and then there is no alternative, literally no alternative, because the politicians won't be paid anything. The central bankers won't be paid anything. Their dollars will be completely worthless unless they stop the rot. And there's only one thing they can do to stop the rot, and that is to mobilize their gold reserves and turn their fiat currency into a gold substitute of some sort. Then they can stabilize the currency if they do it properly. the chances are that they probably won't do it properly. So any stability will probably be fairly temporary. But I think what we're talking about is not a sort of, gold at $5,000 or $10,000 an ounce. What we're looking at, I think, is somewhere in the hundreds of thousands of dollars an ounce before they get round to doing this. And it could
at that
actually
point, it's almost meaningless, right?
This is absolutely, completely meaningless. And this is why I've always tried to encourage people to look at gold, and particularly bullion. It must be bullion, it must be physical gold that you have, whether it's coins or bars, it doesn't matter. But, it's money. And you're going to spend it at the end of the day because you won't have government money. Government currency won't be available. It'll be completely useless. With a bit of luck, they'll turn around and turn their useless fiat currencies into something which actually is backed by gold. But they've got to do it properly. And I would be surprised if, say, the Americans do this properly. But there's so many political elements to this. If you do this and suddenly you find that China's got 20,000 tons of gold and the US hasn't got 8,000, but it's only got 5,000 because they've been fiddling the figures again, then you can see that Langley is going to say, hold on a minute, where's our hegemony gone? This is, we mustn't let this happen. So you can see this, this is going to be a very difficult situation within government itself to manage. And because they don't understand economics, they're all Keynesians, basically. They've got no idea about economics. Who's going to be in charge of this? Who's going to understand what needs to be done? We don't see that person yet.
It's fine. The MMT crowd will take over, Alasdair.
Quite.
Is there anything else you'd like to touch on before we wrap up here?
I think we've probably covered enough to alarm your listeners, viewers, whatever. But I really would. I think the thing to watch now is the interest rate scene. If we see that the purchasing power of currencies is being undermined and interest rates have got to go up, be ahead of the crowd, because that will burst the bubble. And when the bubble bursts, the fiat currencies will also go under. Not immediately, maybe, but for goodness sake, have some real money, and then you might save yourself.
That's a great point, Alasdair. Of course, you write articles that you post them on goldmoney.com. You're also a frequent contributor to King World News, and your most of the links to all of that is all on your Twitter feed at Macleod Finance. Anywhere else you'd like to point to, Alasdair?
No, I think that's it. I do almost all my writing for GoldMoney, all my regular writing, and I have an insight article which is published every Thursday afternoon, Eastern Standard Time, and market report on Friday about the same time. So, there's. I would urge you to try and understand the former and read the latter.
Excellent. Alasdair, thanks so much for your time today.
That's my pleasure, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.